Hello, ladies and gentlemen. I hope you are fine wherever you are. I am the Akatuta, Mr. Jerome Chimkile, and in this video, I'm going to explain one or two questions concerning the week 1 exercises which I've sent you, and I hope by the end of this video you would have been helped in attacking questions linked to consolidated financial statements at SBR level. However, since this is our first lecture, this question is going to be a little bit easy, but I want you to grasp the main tenets or the main concepts with regards to consolidated financial statements, which I think would be very useful for your future endeavors in this study area. So the tips are going to be explained step by step. So please hang on until the end of the video. Okay, just hang on. All right. So our question, ladies and gentlemen, is this one. This is the question, ladies and gentlemen. Question Bensot. Now, Bensot, a public limited company, purchased 6 million shares in Redu, a public limited company, on 1 January 20x5 for 10 million. So that's the information we have so far about this particular company. Let me try to look for a pen. All right, and I hope you are still seeing the question properly. Okay, so this main company, Bensot, is a public limited company which purchased 6 million shares in Redu. Okay, so the company Bensot purchased 6 million shares in Redu. We need to know if this acquisition was indeed a subsidiary, or it was an associate company, or some simple investment. How do we know that this is a subsidiary? Usually, we see, we know that a company that has been purchased is a subsidiary only when the majority of the shares of the voting shares have been purchased. So, the shares of these companies are found in this line. Okay, that's the equity shares. Now, these values are monetary values. Okay, and they are in thousands. Okay, remember, these are monetary values. Now, for you to get the number of shares, you then have to be led by the nominal value of each share. This share is 50 cents each. So which means if we are seeing that this is the column for Redu, okay, so for Redu, the number of shares is going to be found by the value of the shares, 4 million, divided by the nominal value of the share, which is 50 cents. So we can see that the number of shares in total are 8 million. Okay, this is the number of shares. Number of shares in Redu is 8 million. Now, we bought 6 million according to the statement there. 6 million were bought. So if 6 million were bought, so it means 6 million over 8 million. So which means, what was the percentage? The percentage of acquisition was 75%. So therefore, Redu is a 75% subsidiary, which means the NCI is equal to 25%. Are we together, ladies and gentlemen? Then once you have done this, you continue with your question. When was the acquisition done? It was done on the 1st of January 2005. For how much? For 10 million. Redu had purchased 4 million shares in Petrol, a public limited company, for 9 million. Okay, so you do the same. So this was Redu. Okay, now for the other company there, we are then told that this Ridu had purchased the shares of another company a long time before. Okay, before Ridu was acquired, it had already acquired petrol for how much? Okay, it had acquired petrol for 9 million. And how many shares were acquired? 4 million. So what was the percentage acquisition? Okay, so percentage acquisition here we are saying 4 million, all right, divided by the number of shares. I mean, we are told that the shares here, the examiner is very specific. We bought 4 million out of how many shares? Divided by the number of shares in this particular company. So the number of shares we do the same. All right, we are told that the shares were worth 2,500. So 2,500 divided by 0.5. This gives us 5 million. So the shares were 5 million in petrol. The petrol shares, okay, they were 5 million, but we bought 4 million. So therefore, percentage acquisition is 80%. Okay, 4 over 5 million, that's 80%. And now, you then have to, because you need to know the association of these figures. Okay, let me try to enlarge my screen here. All right, let me try to go to the next page. All right, this is usually the standard one working, the group structure. You need to see the group structure clearly. Okay, first of all, we have got Bensot. Bensot acquired Ridu. Okay, Ridu. What was the percentage acquisition? This was 75%. Okay, so the NCI there was 25%. Okay, but we are told that this took place on 1 January 2005. So this was 01 01 20x5. Then we are then told that, but Ridu had purchased the shares. It had purchased the shares in petrol. How many shares were purchased? There were 4 million out of 5 million, so it was an 80% subsidiary. Okay, this was an 80% subsidiary. Okay, so if it was 80%, we then have to then say, okay, this is a vertical relationship. All right, it is a vertical relationship. It's a vertical group. So we then have to don't make a mistake and think that the NCI there is 20%. No, it's not like that. You then have to determine what is called the effective control. Okay, or effective interest. The effective interest of Bensot in P, that is in petrol, is given by 75%, which is the direct control of Bensot in Ridu, multiplied by 80%, which is the direct control of Ridu into P. Okay, and then we get 60%. So the Bensot's control in in P is actually 60%. Why? Because P is a direct subsidiary of Ridu. Okay, but Ridu is a direct subsidiary of Bensot. So Bensot has got an effective interest of only 60%, which means the NCI now is equal to 40%. The NCI in P. All right, so this is how you do it. Don't mind, there is a train passing. Okay, now this is the first stage of your working. Okay, there are no marks actually at this level. There are no marks of doing this, but this actually helps you to maneuver the territory. Okay, so this acquisition was done sometime back at 31 December 20x2. Now let's do the standard working that's gonna give us some marks. Okay, let's calculate the goodwill in both these subsidiaries. Okay, now for the goodwill, you can as well do your workings. There is Redo, there is Petrol. Okay, let me look for a different pen, a black pen. Now, as usual, we start with the consideration transferred. The consideration transferred. Now, the consideration transferred for Redo. When we bought the shares in Redo, we were told that they were bought for 10 million. Okay, so that's the value we use. Sorry, for 10 million. Okay, let's put our figures in thousands. So that's 10,000 for 10 million. All right, let's start with Redo first, and then the non-controlling interest, because you need to add NCI at acquisition. Okay, and this was given in the last statement. Group's policy to value non-controlling interest at fair value at acquisition. The fair value of non-controlling interest in Redo was calculated as 3.23 million on 1 January 2005. The fair value of the 40% non-controlling interest in Petrol on 1 January 2005 was 4.6 million. And I have shown you how to calculate this 40%. And the 40% we are talking about is this one. Okay, I've shown you how to calculate this. This is the 40% they are referring to as the NCI. Okay, but you you might have been confused and say, how did the examiner come up with the 40%? That's how you get the 40%, ladies and gentlemen. So we are told that the NCI at acquisition, the fair value was 3.230. Okay, and what about the net assets at acquisition? Fair value of net assets at acquisition. Okay, the net assets at acquisition, usually net assets consist of the share capital, remember, share capital and retained earnings, sometimes reserves. Okay, retained earnings. All right, so the share capital was how much? Usually the share capital doesn't change. That's the normal assumption. Okay, when it changes, the examiner will tell you, but it doesn't change. All right, so the share capital for Redo was 4 million. Okay, just assume that it did not change. But for the retained earnings now, we are told that the retained earnings were at that date, the retained earnings were 8 million for Redo and 6.5 million for Petrol. So 8 million for Redo. So you can slot them. This was 4 million and these ones were 8 million. Okay, I'm trying to create a column here. All right, so we add them up and we get 12 million. All right, these ones now have to be deducted they've to be deducted from these other figures. Okay, so we see a continuation of the same column. All right, so we get 1.230. So ladies and gentlemen, this is the goodwill in Redo. That's the goodwill in Redo. Then we need to proceed to Petrol. What was the consideration transferred for in Petrol? In the shares of Petrol, okay, that was 9 million. Okay, Redo had paid 9 million in acquiring the 4 million shares in Petrol. Now, okay, now do we have to suppose that the group, or let me just say Bensot paid 9 million in the acquisition of Petrol's shares? No way, it doesn't work like that. It was Ridu who paid 9 million. However, in the eyes of Bensot, the parent, they did not pay 9 million. So 9 million was not fully paid. They only paid 75% because Ridu controls, okay, I mean, Ridu controls 80%, fine, but Ridu is a 75% subsidiary. Remember, Ridu is a 75% subsidiary. So Bensot, when Ridu paid money, the assumption is that Bensot paid 75% of that 9 million. So 75% of 9 million, this gives us 6750. And then the NCI, its acquisition was how much according to the statement? Okay, the fair value of the 40% NCI was actually 4.6 million. All right, now in the examination, ladies and gentlemen, in the examination, usually they will give you two values. They'll give you the fair value of the NCI at the date when the shares, that is in 2002, when the shares were bought. Okay, when the shares were bought, and the fair value when this third company became part of the group. So you then have to use the fair value of the NCI when the company Petrol become part of the group. That is on 1 January 2005 when Ridu was purchased by the parent. Are we together? So this is the amount we are going to use. Okay, so that's 4.6. So NCI here is 4,600. Okay, and what about the fair value of net assets at acquisition? All right, then we go back for the share capital. The share capital of Petrol was how much? Is 2.5, and we expect that that one does not change. 2.5. Okay, 2.5, and the retained earnings when this company was acquired was how much? The retained earnings, the information is given somewhere. Okay, this was 6.5. Okay, we add these figures and we come up with the complete figure of 9 million. We then have to deduct this from the other figures on top there, those figures, and we get our 2.350. Okay, now these are goodwills of individual companies. We then have to add them up and come with a combined figure for the goodwill, which is 3580. Okay, that's the goodwill. Now you then have to look for information on impairment. Okay, and they say that there was no impairment, so the figure is final. You get your 2 to 3 marks here, and then you do your working number 3. Okay, working number 3 is usually for the NCI, and you also need to understand the requirement. You are required to do an SFP, a consolidated statement of financial position. So obviously you need that working. Okay, so the working here is for the NCI. Now the NCI, ladies and gentlemen, follows the same pattern. Okay, we've got two companies. We've got Ridu, we've got Petrol. Okay, there's the two companies we have. Redo, and Petrol. Now, our figures are in thousands as usual. Okay, and then we've got NCI at acquisition. This is the figure which we determined it should be the same as this figure. Okay, this is the NCI at acquisition, ladies and gentlemen. So those are the figures you just have to copy and paste. Okay, 3230 and 4.6. Sorry, 3230 4.6. Then the NCI share of post acquisition retained earnings. Okay, now we need to determine these retained earnings, the post. Okay, how do you get that? So you say, let's say for redo, if we go to our statement of financial position as given, these are the retained earnings figures. Okay, retained earnings. So redo now has 20.4 million, and this other company has got 16.3. Now let's start with redo. Now redo now has got 20.4 million, but it had initially how much when it was acquired? The retained earnings were standing at 8 million. Okay, so we are going to say 20.4 minus 8 million. 20.4 minus 8 million. Okay, multiply by the percentage of NCI, and we determine that the NCI percentage was 25%. We get 3.1. We do the same for petrol. Petrol currently, according to the statement of financial position, now has got 16.3, but it had 6.5. So 16.3 minus 6.5. Multiply by 40%. We determine that the NCI is 40%. So this gives us 3.920. Okay. Then let me verify the difference there. We are talking of 16.3 minus 6,500. Okay, that's fine. And then we multiply by 0.4, 3.920. Yes, 3.920. And then we then have to deduct the NCI share of investment. Share of investment in petrol. This is the group NCI in the investment in petrol. Okay, I mean the NCI, reduce NCI in the investment of petrol. Now, we know that when we calculated the consideration transferred, we only say that Bensot paid 75%. So the NCI should also fill the same part. Okay, so the NCI there in redo was 25%. So we are going to say 25%. Okay, multiply by the consideration transferred, or the investment, the cost of the investment, which was 9 million. And we get 2.5. So the NCI value should also be reduced. Okay, when we do the reduce, All right, okay. When we do the reduction, we're going to say 408. Okay, if you do your mathematics very well, and then if we add up these figures on the last column, we are going to get 8520. All right, then we need to combine these figures to come up with the total NCI. This is the total NCI, which is going to be 12600. Then we have to do the working for the retained earnings. For the retained earnings, we do the same. We have got two companies, Redo and Petrol. Our figures have to be in thousands. Okay, they're the figures. So we start with the figure per question. Now, here we're going to take, if we're saying per question, we are simply saying we are going to take according to the reporting date figures. Okay, so we go back to our statement of financial position, ladies and gentlemen, and we go to the section of retained earnings. We're going to take all these figures. This is per reporting. Okay, so those figures, that line, you just have to copy and paste. So that's 25.5, that's the first figure there, 25.5, and then we've got 20, sorry, this is the parent, 25.5, and then we've got for Bensot, for Redo, we've got 20.4 and 16,300. Okay, and then we then have to worry about the retained earnings at acquisition. At acquisition, okay, here there is a zero because the parent cannot purchase itself. Okay, but we are told that when we acquired Redo, the retained earnings were 8 million. We need to remove these ones, and when this one was acquired, the retained earnings were standing at 6.5 million. They have to be removed. Then we get here it's 12.4. There is 9800. Then we have to worry about the group share of post. The group share of post acquisition. Sorry. Post acquisition retained earnings. All right, we do the same. Like we know that when at reporting date we had 20.4 in Redo. Let's start with Redo. Okay, we had 20.4, but initially they were 8 million. Okay, so multiply by 75%. Right, if you multiply by 75%, we get 9.3. Remember, this figure, okay, this figure, the 20.4 is just the same as this figure. The 8 million is the 8 million we are talking about here. So we shouldn't have just taken this 12.4 as our post acquisition RE. All right, so but here I just did it just for your memory. Okay, so 75% of 12.4 is actually 3.1. This should be in the column of the parent. Then when we come to Petrol, we just take this figure, the 9.8. So that's 9.8 multiplied by 60% now. This is the 60% subsidiary. 60%, okay, and we have to get 5880. Okay, so we then have to add everything in the column of the parent, because remember, only the parent figures are going to to be consolidated.
Okay, so if we add, all right, like I said, this is the column we are adding, ladies and gentlemen. Okay, what's going on? All right. Okay, I'm sorry. I'm trying to find the pen. So this is the column, the parent column. That's that's the column that is going to give us the total retained earnings to appear in our consolidated statement of financial position. So we are going to add this figure and this figure and this figure, and we get the total. Okay, and our total should be 40,608. Remember, this is 40,680,000. So that's the total retained earnings figure. Okay, now that we have done all the essential workings, we are then ready to do the consolidated statement of financial position. So let us do that one quickly. So consolidated statement of financial position as at, the question was saying as at what? The question should lead us as at 31 December 2009. Sorry. 31 December 2009. In the examination, you just have to write the full date. Do not put it in short form like this. Okay, and do not forget to write the name of the group. In this case, this is the Bensot group in full. Okay, consolidated statement of financial position as at 31 December 2009. And as usual, we start with the assets. The assets, we've got the non-current assets. Okay, and we can put all the figures in thousands. All right, so the non-current assets, we are going to have, let us look at the balance sheet given in the question. We have got this one. Okay, so since this is a consolidation, we're going to add line by line. So these figures are going to be added across, and there have been no movement in fair values and so forth. So the fair values, there were no adjustments. So these are the figures. So we are going to add for the PPE, we add line by line, as I have indicated. I mean item to item. So PPE. Okay, we take the parent figure, which was 14,500 plus 12,140 plus 17,500 for petrol, and we get a total of 44,140. All right, and then the other thing here, we are not going to check this figure. I mean, these figures are not going to be taken for the purpose of consolidated statement of financial position. Okay, the only figure that is going to appear is the goodwill in respect of those companies. So goodwill. And goodwill was in working number 3 if I'm not mistaken, on working number 2. Let me see. Okay, working number 2. So the goodwill figure is this one, 3580. So we come down here. This is working number 2. Okay, 3580. We add up and we get the total non-current assets of 47,720. Okay, then we move on to the current assets. The current assets, we're going to have inventories, trade receivables, okay, and cash or bank. All right, so there's been no adjustments again for these figures, so you just have to go to our statement of financial position. It's given in the question, and we are going to say this figure plus that figure plus this one. And this one for the trade receivable, we're going to do the same. For the cash, we do the same. Okay. So let us slot in those figures as quickly as possible. So for the trade, for the inventories, we're going to say 6,300 plus 2.1 plus 450, and we get a total of 8850. For the trade receivables, we have got 4.9 plus 2,000 plus 2320. We get a total of 9220. For the cash, we are going to have 500 plus 1440 plus 515, and we get 2455. And the total we have here is 25. Then we add this figure with that one for the non-current assets. We get the total assets figure. That is 47,720 plus 2525. That is going to give us 68,245. Then the other section, that's equities and liabilities. This is equity. Sorry, liabilities section. We start with the share capital. The share capital, we are only going to take 50% ordinary shares. We are only going to check the figure for the parent. So we go back to our statement of financial position. It's given in the question. We are only going to check this figure, 5,000. Okay, those are the rules, ladies and gentlemen, and we mustn't be found wanting. So that's 5,000. You only take for the parent only. Okay, and then retained earnings as worked on working number 4. And our figure was how much for the retained earnings? We found that this was 4680. Okay. If we add, we get 45,680. Then the NCI, this was working number 3. The NCI was how much from our working? The NCI, this is the NCI, total NCI was 12,600. Okay, you can decide to add there or just have to continue. Let us just continue. We only have got current liabilities. There was no non-current liabilities. So current liabilities. Okay, and this one we also have to add line, across, we just have to add across. So the question, there was no current, non-current liability, so we just have to add this figure plus that figure. So those are the figures, the three figures that have to be added across. So that's, we have got 572280 plus 1985. Let me cross check. Yes. So the total there should be 9965. Then we add to come up with the full total for the total equities and liabilities. And this should be 68245. And you can see clearly there that these figures are just the same, this figure and that figure. So we have actually balanced our statement of financial position, which means we are right on track. Okay, that's our statement of financial position, ladies and gentlemen. All right, then there is this particular question. I just want to point out certain things which I feel we all need to know. Okay, in this particular paper, the ACA SBR, the Strategic Business Reporting paper, we are also required to show the examiners that we are saturated theoretically. We know what we are doing. We know all the theoretical underpinnings of accounting. So we need to at least show that we know what we are doing. Okay, you're not only going to be tested on calculative problems. You're also going to be tested on certain questions which require your cognitive appreciation of accounting. Okay, so this question is saying, while it's acknowledging the importance of high quality corporate reporting, the recommendations to improve it are sometimes questioned on the basis that the marketplace for capital can determine the nature and quality of corporate reporting. It could be argued that additional accounting and disclosure standards would only distort a market mechanism that already works well and would add cost to the reporting mechanism with no apparent benefit. It could be said that accounting standards create costly, inefficient, and unnecessary regulation. It could be argued that increased disclosure reduces risk and offers a degree of protection to users. However, increased disclosure has several costs to the preparer of financial statements. Required: A. Explain why accounting standards are needed to help the market mechanism work effectively for the benefit of preparers and users of corporate reports. Okay, so this question is saying explain. All right, it's actually a very important word or term, explain. All right, so which means you need to at least try to bring the case, try to explain what are those standards. Okay, and then when you explain, when you at least show what accounting standards are, you then have to explain, okay, or to give the reason why they are important or why they are going to help the market mechanism. So, like I said, you need to at least define or describe what accounting standards are and what the market mechanism is, okay, and then explain the benefit. of having those standards?
Okay, so without limiting you to cramming, you just have to write one or two sentences explaining what accounting standards are, and then a little bit about what a market mechanism is. Okay, because by the end of the day, the idea of having global accounting standards or regional accounting standards is to ensure that the accounting reporting, I mean the financial reporting is well regulated and um, is conducive for comparability of information, verifiability of information, something like neutrality. Okay, by the end of the day, we expect that high quality accounting standards would enable neutrality of information. Okay, neutrality. That is, the information will have no bias. Okay, it is objective. Okay, and then as I've already said, there should be some comparability. So these are actually the reasons why, or the benefits why, or from having high quality accounting standards. All right. The other reason is comprehensiveness. These accounting standards are usually comprehensive or well detailed, such that they are prescriptive, which means they encourage the preparers of financial information to produce comprehensive financial information that is going to be very useful to the users of those financial statements. Okay, I've also spoken about the verifiability of information. All right, if we have a certain rule book or some reference points, all right, we are now in a position to force preparers to follow a certain rule or a certain framework, which means when we want to audit what they've done, we have got a starting point. We have got a reference point where we can use as which we can use as a benchmark. Okay, so that we verify whatever they have prepared. Now, you can see that these 9 marks can be raised if you know your principles, your theory. Okay, the theory, and most of these aspects are found on the conceptual framework. Okay, and the theory around that area. Then part B was saying discuss the benefits of to the users of financial statements and relative costs. So here you need to discuss both the benefits and the costs associated with the preparation of financial statements in terms of increased disclosure. So the benefits of increased disclosure and the costs associated to it. All right, so you need to start with your benefits. All right, do not just regurgitate on what you have written on part A. You need to be very vigilant. Okay, part B is actually asking you the real reasons, the tangible reasons, giving examples. For example, you need to outline the reasons why increased disclosure is important, let's say, to a lender. All right, why would a lender be interested in full closure? This is the lenders, for example, they would want more information about the risks associated with investing in a particular company, right? Something like that. So the assessment of risk, assessment of liquidity. When we're talking of risk, for example, credit risk. Okay, some companies, when you give them money, they're not going to be able to repay you back. Okay, so credit risk, then liquidity risk itself is also a risk. Some companies, um, they they are bound to fail because they no longer have they don't have money at all, or their industry is likely to fail even if you give them money. Why? Because of certain technicalities in the economy. Okay, the economy doesn't have money at all, and it is bound to fail. So if we have full closure of the business attributes, we are likely to be in a position of coming up with better decisions as to whether we have to invest in them or to finance them or not. Okay, but you also need to know that when you discuss the benefits, you do not only have to discuss them from the risk perspective. Sometimes you discuss these benefits um, from the profitability perspective. If we have got full information about a company, we are also in a better position to know if it is worthwhile to invest in them. For example, if a company is profitable, we are likely to be motivated to invest in that particular company. So the full closure or full disclosure of um, the profitability potential should be actually made known to the potential investors so that they come in their numbers and invest in this particular company. So you need to cast your net wide when you are responding to questions like this. You mustn't be blinkered. Just have to be very flexible, very dexterous. Okay, you need to be agile. All right, because if you are rigid and thinking of one thing, you're not going to raise enough points to earn marks. All right, what about the costs associated? Sometimes these disclosures are going uh, I mean, to be costly to the company, such that the benefits are going to be outweighed by the costs. All right, there's also going to be some litigation risk. Okay, litigation. A company might be sued if the disclosures which are required are so vague, they're not clear. Okay, which means the company might be sued. All right, some of the disclosure requirements might be complex, such that there is likely to be distortion in an attempt to give full closure. There is also a risk of loss of competitive advantage. Loss of competitive advantage. When we are talking of competitive advantage, ladies and gentlemen, we are saying that certain things or certain information need not to be made to the public, need not to be made known to the public. All right. For example, the information on the disclosure might be too might be selling out the company's core competencies. All right, core competencies, such that the competitors are likely to get essential information so easy because they simply just read our annual report and they found out that this is what we are doing and they are going to quote what we are doing, and by the end of the day we are out of business. So certain disclosures might end up impede the competitiveness of companies. So that type of reasoning is very essential when you are attacking questions like this. So this was just, let me just say, a tip, okay, of the iceberg. All right, you need to read around this area. Also, you need to focus on what I can say current developments in accounting. All right, uh, you need to read about new articles concerning current development in terms of regulation, new accounting standards, uh, or maybe exposure drafts. You need to know the exposure drafts, the IASB exposure drafts. You need to read around them. You need to know what is happening, what is coming up, what is current, which one is the current work of the ISP, so that you know, because questions like this will be testing you on current issues. Those current issues are going to come in the exam, so you need to read around that area. Okay, I hope I have given you some hints, and you have enjoyed this piece of presentation. Until next time, ladies and gentlemen, please let's continue to support one another. These are my numbers. Okay, that's my number. If you feel like you need to talk to me, or you want to talk to me, or to engage me in your studies for the ACA SBR or any other ACA paper, please feel free to contact me on WhatsApp or direct call, okay, on that number. I'll be there to respond to you. Okay, I am signing out. Thank you.